Got a great team to set you up for this morning's decision. Royce Mendes is Managing Director and Head of Macro Strategy at Desjardins. He thinks the BoC will forego any more hikes this cycle. Joining us here in studio, Karl Schamotta, Chief Market Strategist at Corpay, who says even as rate cuts are expected in early 2024, policymakers cannot declare mission accomplished just yet. Great to have both of you with us. I will start, I guess, Royce, with you. You think they're done?
I think they're done. I don't think it's surprising that we're seeing the data in Canada weakening. We're looking at a second half of this year where the economy could very well fall into recession if it hasn't already. And there's more pain to come. We know that there's still a majority of mortgage holders in this country that have yet to renew in this higher interest rate environment. And as that happens, more money will be diverted away from spending in the economy and towards debt service, and that's only going to slow the economy more. So, I think that the bank, by raising rates as aggressively as it did, it was able to more or less get inflation on a path back towards 2%, but it's likely to come with a recession as a result of those rate hikes. And the question will be is whether it was worth it.
And Karl Schamotta, the pain tolerance, I guess, if there's, Roy's talking about more pain ahead and the balancing act at this point for the Bank of Canada?
Yeah, I think they do have relatively high pain tolerance, given that this is something that they engineered deliberately, right? Policymakers around the world have ratcheted rates higher in an attempt to bring about exactly what we're seeing, that sort of cooling in excess demand, that diminishment inflation pressures. That's all what was on the docket. Now, the problem here is whether they allow markets to, begin anticipating cuts. So what they're going to try to do in their communications today and likely for many months yet is continue that higher for longer narrative. They're going to try to convince markets that rate cuts are not coming in early 2024 because they do not want to see this, inflationary conditions come back. They don't want to see Canadians do what they did earlier this year and suddenly jump back into the housing market, right? They want to follow that path that Royce is setting out there.
So the psychology is part of this, I suppose. But Royce, when you look into 2024, beyond just holding the line on interest rates, given the worries that you just raised, what's your own expectation in terms of where interest rates go in this country next year?
I think we're headed for cuts. I said this the last time I was on your show that I thought the next move, in 2024 when it comes will be a rate cut. I think that we're done with rate hikes for this cycle. But even with rate cuts, what we'll see is that Canadians will still be facing higher borrowing costs than they faced pre-pandemic, and certainly during the early days of 2020 and 2021 when interest rates were so low. And so even if there are rate cuts, it's not going to completely erase the hardship that Canadians will face as a result of a more secular move to at least a slightly higher, longer-term interest rate environment. And I think when we look out to 2024, there's probably rate cuts, but when we get into 2025 and 2026, rates are probably going to remain, relatively low relative to where they are today because there's so much debt that'll be renewing in 2025 and 2026. And even if they do, you'll still have a lot of pain in those years.
So this is interesting, Karl. Some people looked at higher rates as being a more normalized economy after years and years of very low interest rates. Royce seems to be painting a picture that we're staring at a road ahead, which likely could have lower rates than what we're seeing right now, because this has been quite a shock to the system.
Yes.
But I guess what's the trade-off? I mean, the fight against inflation, that was also going to be a very challenging one for the pocketbooks of Canadians. What's the better choice here for the Bank of Canada to have made?
Well, I do think that very much, as Royce is saying, that rates do need to come down a bit from where they are today. This sort of period of pain is going to pass to some degree, but the long-term carrying capacity of the economy is diminished given that enormous debt load that the private sector, both corporates and households, have in Canada. So ultimately, the question here isn't the absolute level of interest rates, it's the carrying cost. It is, the interest rate multiplied by that outstanding debt load. And as Royce mentions there, as that gets refinanced, that goes up and up. And so the question in the long run here is more whether the Canadian economy can withstand a real regime change here. It's not just this sort of period of bitter medicine that we're going through, but in the long run, what happens to the entire structure of the Canadian economy when borrowing costs so much and Canadian households and corporates are handing so much away in order to cover debt payments.
And Royce, I mean, what does that mean on the inflation front? I mean, like, to the point about borrowing costs, we've already heard about for the federal government itself, that they're going to be navigating higher borrowing costs on top of the spending that we've already committed to. But we've heard this conversation around new geopolitical realities in the world, new supply chains, these sort of longer-term inflationary forces that won't go away. Does that mean we have to prepare, perhaps, for higher inflation levels than what typically central banks have sought for so many years?
Well, I think the central banks are committed to getting inflation back down to their more or less 2% targets. But what it'll take to get there, we've seen, is a lot, relatively high interest rates. And that's why it's so important that they get inflation under control now and don't wait. I think governments have to recognize that the regime has changed in terms of the prevailing environment. They had a lot of leeway pre-pandemic in terms of building up debt loads because economic growth was so much higher than the interest rate. But in today's world, that margin is very thin. And so they need to create buffers and be much more cautious with spending decisions than they were pre-pandemic. Overall, though, I think that you're right. We are probably facing more inflationary pressures because of geopolitical shifts around the world, because of things like reshoring or the green transition. And we have to all take those into account, whether it's governments, whether it's households as well. I think even if we get to a 2.5% rate from the Bank of Canada in 2024, 2025, that's still higher than the peak of the last cycle. That's not really that low in terms of the pre-pandemic decade. It's actually quite high. And so even in that environment, governments, households, businesses all have to think a little bit differently.
Royce, I'm just going to, before we take a quick break, Karl, I want to come back to you. Royce said that he thinks the Bank of Canada is done in this rate hiking cycle. Is that your view? And I made the point about the U.S. Fed because they may be closer to the end of the rate hiking cycle, but I think there are some people who still think they've got more rate hikes ahead.
Right. I think if we do see a rate hike in North America later this year, it'll be the U.S., not Canada. I do think that as we've really outlined here, the vulnerabilities in the Canadian economy are clear and the downside is beginning to show up. So, this is a bank that is going to move to a data-dependent stance, and then they're going to move onto the sidelines in a more firm way by early 2024. So we don't expect cuts until mid-2024 at the earliest, but we do think that this is the peak in the cycle right now.
Okay.